Good morning. Welcome to CATEX-TV. My name is Frank Fortunato. This is a live broadcast from Princeton, New Jersey. Today is Friday, February 27, 2009. It's thankfully the last weekday in the month of February. This will be a good month to get behind us. It's 11:30 a.m. Eastern Standard Time in the U.S. It's 4:30 p.m. in London. If you need to reach us during the broadcast, you can phone in toll-free at 1-866-67-CATEX. Overseas, our AOL instant mail address is CATEX-TV. More bad news for Citibank. The house that Sandy Weill built is gradually being taken apart step by step. Citibank shares are now trading at $1.65 a share. They're down about 81% today. It's hard to believe. This is a bank that was trading at probably $90 a share 2 years ago. Here's why. Citigroup said this morning that it had reached a deal with the U.S. government that would give the government up to a 36% stake in the bank. The government, along with private investors, will convert some of their preferred stock in Citibank to common shares. Citibank will offer to exchange up to $27.5 billion of its existing preferred stock held by private investors at a conversion price of $3.25 a share. That was a 32% premium over the closing price of last night. It's a 100% premium right now over the current price that's being traded. The government will match up to $25 billion of the preferred stock it currently owns for conversion at the same price. That conversion will help provide Citibank the mix of capital to further withstand weakening in the economy. The government of Singapore's investment group, which is a sovereign wealth fund, the Saudi Arabian Prince Alawid bin Talal, Capital Global Research Investors, and Capital World Investors are among the private investors that said that they've agreed that they would participate in the exchange. Citibank has already received $45 billion in cash from the government. Under the exchange agreement, the Treasury Department's remaining $20 billion in preferred shares will be converted into a more senior preferred stock that carries an 8% cash dividend rate. That seems atmospheric at this point. Citigroup said that the increase in government ownership will not require additional taxpayer money. Nobody quite knows how that statement was made. Bloomberg Radio is laughing at that this morning. The government currently holds about an 8% stake in Citibank. More bad news. The U.S. economy's GDP, gross domestic product, fell at a 6.2% seasonally adjusted annualized rate in the final 3 months of 2008. This is the fastest drop since 1982. According to the Commerce Department, these are figures that are revised from an initial estimate of 3.8%. That's almost a doubling. Economists surveyed by MarketWatch had expected a revision down to a decline of 5.5%. Instead, it came in 0.7% worse than that. The revision showed that inventory investment and exports were substantially weaker than first reported. Consumer spending also was revised lower. We've been reporting for the past few weeks on the trials and tribulations of Hartford. Earlier this week, it was announced that Mr. Mara, the chief operating officer, was going to be leaving. Ramanier is up there trying to desperately fill the holes, and he's got another hole to fill today. Standard & Poor's said that they have downgraded Hartford Financial Services Group financial strength ratings to A+ from AA-. This is amid growing concerns over the firm's capital adequacy. S&P said that the additional capital required to fund the Hartford's increase in variable annuity reserves, on top of possible capital charges under asset stress assumptions, could, quote, meaningfully exceed the undeployed capital resources Hartford has on its balance sheet. The ratings agency based its assumption on the market levels of the past week, adding that should declines persist or worsen, the Hartford would need to increase its financial leverage materially to cover a funding shortfall at Hartford Life. S&P also downgraded the group's counterparty credit rating to BBB+ from A-, and it kept Hartford on credit watch with negative implications. The downgrade, of course, follows the insurer's Q4 results, which saw heavy losses on the Hartford's life business. On the other side of the spectrum, Royal Sun Alliance has joined a small group of insurers that is bucking this trend. In fact, they got a ratings upgrade. AM Best bumped them up to A, excellent, from A-. in recognition of, quote, sustained improvement in the group's consolidated risk-adjusted capitalization. RSA now joins Fairfax and Axis Capital in swimming against the tide and receiving upgrades. Fairfax was upgraded in January, and Axis was upgraded at the beginning of February. The London syndicate Hardy is raising £40 million via a fully underwritten placement and open offer. The company wants the money to take advantage of the opportunities presented by the improving insurance market conditions. Translation, the hard market. Ms. Barbara Merry, the CEO of Hardy, said that the insurer is, quote, perfectly positioned to take advantage of the return of the hard market. The company wants to take advantage of the hardening rates and the current shortage of capital to pursue more rapid growth. It did pretty well in 2008. They announced their financial results. It showed record profits of over £23 million and net tangible assets of 245 pence per share. It's proposing a 10% increase in the 2008 dividend of 12.1 pence per existing common share. Buried in the small print of President Obama's budget blueprint that was sent up to Capitol Hill yesterday is this little nugget. This affects the Federal Crop Insurance Corporation. You might have some trouble reading that on that logo, but that's the logo of the Federal Crop Insurance Corporation. Insurers that administer the U.S. Agriculture Department's crop insurance program will see their federal paycheck cut by $5.2 billion over the next decade as the Obama administration looks to cut waste. The budget proposal said over the last several years, subsidies for crop insurance companies have grown rapidly without improving program coverage or customer service for the farmers. The program's budget will be cut by $429 million in 2011, with annual cuts totaling $2.1 billion by 2014. A total of $5.2 billion will be realized by 2019. The cuts will both reduce payments to insurers and increase fees charged to farmers. Listen to this. In 2007, farmers paid just over $6.5 billion in crop insurance premiums. The government, however, paid insurers $1.3 billion in administrative fees. No wonder that's something that the president is looking to cut. The program's administered by 16 insurers that participate in the program, including ACE, Wells Fargo, and American Financial Group. The stock market overall now is down about 63 points. We'll go to a word from our sponsors and come back with the rest of the news.
Every day, the world wakes up and goes to work, pursuing the unique opportunities that lead the global economy forward. The complexity and close connectivity of today's global marketplace is a true modern miracle that can create unparalleled success. But it takes confidence, passion, innovation, and understanding.
Enabling opportunity. Protecting capital.
Engineering innovation. Investing in your future.
Ensuring continuity.
Finding the right balance.
It takes Aon.
We follow this story every year simply because it's a little bit unbelievable to people, at least in the northeastern part of the United States. This is a picture of Seoul, South Korea last year. Seoul is the capital, of course, of South Korea. This is the capital under one of the annual yellow dust storms. One is forecast coming this weekend. These are especially severe storms from China and Mongolia